So let's talk about this and more with our friend, BFG Wealth Partners Chief Investment Officer, Peter Boockvar, also a CNBC contributor. Peter, again, U.S. markets have done great. But to what do you attribute this, Korea doubling in a year?
Memory chips.
As we entered 2025, the U.S. market cap as a percent of total market cap got to the highest level since World War II, north of 60%.
Of the global market.
Of the global market cap, with context that the U.S. economy is about 25% of global GDP. So U.S. dominance was just so extreme, and we were due for a swing in the other direction with the pendulum. I think that the dollar weakness last year, where the first half of the year we saw the worst dollar performance since the early 70s, was a major catalyst. And investors that said, hey, 7 stocks are not all of our choices. We have an entire world of opportunities, and they took advantage of it because it wasn't just the U.S. that all of a sudden became a tech play. It wasn't just the U.S. where we saw earnings growth. And it's, like I said, most of the global GDP actually takes place outside the U.S. And you know what? 96% of the world's population is also outside the U.S.
But I didn't want to hear it. You know why? Because they say, well, where's the innovation coming from? Where are the multi-trillion-dollar opportunities come from? In other words, in the long run, give me a case that I should be in Europe or a case that I should be in emerging markets. And I was wrong, because not only did they all levitate last year, to Brian's point, they are still flying this year. And people who come on, yourself included, say you can still invest in them. They talk about deregulation happening in Europe, or look at how commodities would benefit emerging markets. So, yeah, how much more room is there to run?
Well, agree with the trade war or not, what it did was kicked a lot of these countries in the pants and said, get your stuff together. And I think that's what we're seeing. Not only that, from an internal standpoint, in terms of deregulating and cutting red tape and bureaucracy, all the trade deals we're seeing outside the U.S. Look at India, with the EU, with each other, and Canada, and Carney going to China. And all these countries are saying, we can't rely on the U.S. like we used to. We need to create our own relationships, and we need to start actually jump-starting our economy.
And I made, when we said that in the open, I made sure I put in U.S. dollar terms, because I think, tell me if I'm wrong, Peter, the reduction in value of the U.S. dollar against many of those currencies is a big part of the story, is it not?
Yes, I would say, depending on which country, maybe almost a third of the returns in dollar terms was because of the weaker dollar.
But it's still real. It's still real.
There were still big returns, but that weakness in the dollar definitely juiced it. Now, flip that. If you were an investor in Germany last year that bought the S&P 500 in euros, well, you had a pretty soft year.
Exactly.
But that dollar weakness definitely is adding to that. And also, the other thing that was interesting is that foreigners still continued to invest in the U.S. last year, but they hedged their dollar exposure to an extent that I've not seen before. So they said, yeah, we'll own the Mag 7 stocks, but we need to hedge up.
I know you're not a big fan of kind of the Mag 7 trade, and that really has been sputtering out a little bit. And again, notwithstanding Google being up 70% in the past year, but this fight against each other for AI dominance is clearly taking some degree of a toll. So do you look now and say, okay, if you haven't been in internationals and emerging markets in Europe, go ahead. Is it green light? Like, go ahead, don't worry about it? Or would you caveat this a little bit?
No, I think what we saw last year, and actually started to see it in 2024, is going to continue. If you want to look at where are the attractive stocks, a lot of them are outside the U.S., but also there are plenty of value stocks in the U.S. because we talk about tech. But if tech is going to be successful, they have to sell their tech to the rest of us. And if we can integrate those technologies into our business and make us more efficient, well, then maybe that's good for our earnings and eventually good for our stock.
I guess it's confusing, though, because I've been in Europe a few times for CNBC reporting on their what I'll call self-immolation of their economy vis-a-vis very poor and short-sighted energy policies. Asterisks, my opinion. And yet people watch that, and then 3 years later, the stock market in Germany booms. One of my predictions 2 years ago was that Germany would boom. And people say, well, it's counter. You're sort of you're going against your own reporting. No, because it got so cheap. It got to the point where it was like, I'll pick those up when they're.
Thank you.
It got to the point where it was like 8 times, 10 times earnings, Peter. And I think there's a lesson here, which is no matter how bad things may seem, investors, I think, need to look at valuation, not just where's the innovation coming from? It's 8 times earnings. At some point, even that becomes,
compelling.
You can't ignore it.
Exactly. Going from 8 times to 12 times because things get less bad, that's a 50% return in your market. We saw that in Hong Kong going into 2024, where everyone started to talk about uninvestable China, uninvestable Hong Kong, and that's been one of the best performing markets since then because the things got so cheap, and actually people realized, you know what, it is investable. So valuations don't matter until they do, and I do think when people started to pay more attention to the valuations in U.S. markets, particularly Mag 7, because Mag 7 became a global reserve asset. The whole world piled into these stocks. Once they finally started to realize that maybe this momentum is waning a bit, let's start diversifying and buying other things, the overseas markets were just a natural place to go.